everybody. Good day. I'd like to first thank Sintercafe for inviting me again to lovely Costa Rica for this conference. It's especially nice in November when London is 5 degrees outside. Today, of course, I think what we're going to focus on, and as the title of my presentation suggests, the topic will be surplus. And one of the main price movers, I think, for the Arabica market in the past couple of years has been surplus. So we're going to look at the dynamics of that and a kind of outlook as well, and what we are seeing at BMP for the next coming years. I'm going to try to break it down from the fundamentals, what currency is doing, as well as prices in general. Everybody is familiar with this graph. You have the Arabica price on the top, the Robusta price in blue on the bottom, and the arbitrage between the two values in gray. And what happened is the main dynamic of this graph in the last couple of years. A very tight, washed Arabica supply due to lower production in Colombia led to a direct rally on the New York Futures Exchange. And what did that do? But it encouraged production. And I think that nobody should underestimate the kind of production prompting that $3.30 Arabica prices do. And what that meant is many places around the world, including Africa, Central America, Brazil, really put some money into production, whether that is increasing their fertilizer use, so short-term production impacts, as well as long-term. And that really helped bring in more coffee in the past couple of years than we had previous to this rally. What it also did is it shifted the demand of the industry for the types of coffee they were buying. It was a very simple progression between a need for Colombian and central washed milds to being more focused on Brazilian supply, simply based on high differentials, and then based on high prices in New York, and then the shift into Robusta, which also can't be underestimated. Robusta is supported by a good demand growth based on emerging market and producer consumption trends. But in 2011 and 2012, what we found is that many roasters and many end users were shifting their blends into a more heavily Robusta product. If we look at a longer scale of this exact same graph before, what we see that there's some cycles in the coffee industry. We have the 1997 rally, which then resulted, of course, in a multi-year depressed price scenario in which we went from 2001 all the way to 2004 or 5 at very low prices that were below the cost of production for numerous producers. And what we found in that region, in that time, was that production shifted to lower cost areas around the globe, and many people who couldn't produce under these costs and under these prices that were available had to either move out of coffee or try to develop other streams of revenue. Now it's interesting because if you take the 2010 2013 price dynamic and you shadow that with what happened in 1997, you get a very close a very similar peak and valley system here. So again, the black line is the quarterly price of ICE Arabica front month values from 2009 to 2013. So where we are right now is here. And the green line is the 1997-2002 price movement that's been adjusted for inflation as well. Now, one of the questions we get a lot is what kind of further downside can we have on Arabica prices? And one of the answers is simply right here. If you look at where we bottomed out in the coffee crisis in 2002, 2003, it was 41 cents on New York. But if you adjust that for inflation, it's in the low 60s, 63 cents a pound in New York. Differentials, quick point out that differentials have not been able to, of course, compensate for the lower prices of the futures markets, meaning that the revenue generated by producers is not being compensated this way. And because differentials in spot market right now is very loose, and differentials are relatively weak, what we feel is that farmers are still selling into this market, which is expected, of course, given that they have the coffee and they need to have the cash flow. But it, of course, is also a bearish dynamic because the inability to hold coffee off of the market based on the balance sheet of most producers means that even though prices are below the cost of production, there's nothing producers can do. They have to sell into it. One modestly shining light in all of this is the difference between Arabica and Robusta. So what we have here is domestic prices in Brazil. We have the blue line is generally a lower priced Arabica, and the green line is the local Robusta. And what we find is that the arbitrage between these two values has come off quite significantly. Now, I'm going to say this, but I want to make sure that nobody thinks that I believe that there's going to be a wholesale change and shift of demand back into Arabica from people who were using Robusta before. Major roasters, major end users, especially in the Western markets, are not likely to do that. I think that the fact that there is still 37 cents of a difference between Arabica and Robusta means that they're still going to be maxing or using as much Robusta as possible, given their product. But a number of, very sensitive this thing, a number of places like Brazil, and especially Brazil, with the arbitrage coming down, we think that there's actually going to be a modest shift at these producer regions. Brazil is the typical case where instead of consuming the Robusta, which they generally do domestically, they would export more of it because the Robusta prices are would be better internationally, and they would consume more Arabica, meaning less Arabica is available for export. This isn't a major shift in demand, but it is an incremental support measure that does help the Arabica market in New York and is, I think, going to be a function of this arbitrage between the two varieties, and that's something that's going to be very key in the coming years. Basically, the overview there, I mean, I think that one of the key takeaways is that we simply have come down 68% now in the New York market, and we've come down 45% in the Robusta market. The question is, of course, how much further are we going to go? And we're going to look at the fundamental now to try to answer that question and see the outlook of supply. As I was saying, the high prices supported production, and that is directly related to the fact that instead of the world production demand sequence going in from deficit to surplus, which it generally does based on the Brazilian on-off crop cycle, the last number of seasons we've had surpluses. Granted, in 12-13 it was a very, very slight surplus. This is all coffee, by the way. But the previous season, 12-13, we had 8 to 9 million extra bags of coffee. This season it's much lower, I believe. In 13-14, it looks to be between 3 and 4 million bags. But I don't think that's necessarily the problem in itself. It's also that 14-15, the year ahead of us, so 11 months from now, there is the expectations that we will be in yet another surplus, simply based on the fact that you have a very large Brazilian crop probably coming online. There's a lot of numbers being thrown out there, and it's very early still, but you can expect potentially 58 to 62 million bags of production in Brazil for total coffee from 14-15. What that means is that when we have surpluses, we build stocks. And this is the global ending stocks at consumers and at producers, and the line is the stocks-to-use ratio. It's a very clear relationship between when we have rallies in coffee. It generally means that we have low stocks, and people are worried about supply, and they are short. So there's a lot of buying, meaning prices go up. And then, of course, when there are very high stocks, the concerns about production and the concerns about supply disruptions diminish, which means that there's less risk involved in the market, and buyers and industry aren't necessarily concerned about coverage. And you have hedge funds also coming in on the short side because they believe the price needs to go down to reflect the fundamentals. But I think the problem is that when we were in 2009, 10, and 10, 11, we had a very low stock use number, and we did have low stocks, but we have been building them successively now for the past couple of seasons. And this is important. We're not yet at burdensome levels where we were in 2010. We have not yet built those kind of stocks yet, despite the fact that prices have come down so far. And I think that's an important dynamic when we're looking forward. Talk about that more in a little bit. So from production and stocks, we go to demand. Demand is growing in coffee. I think we've heard that a couple of times in the last couple of days. But demand growth in coffee is not even. Like I mentioned before, Robusta demand grows at a much higher rate than Arabica demand in the last 10 years, averaging around 4.5% to 5%. And then when we had the year that we shifted from Arabica to Robusta demand, that was blown out quite a bit. Arabica demand, again, this is demand that's based in Europe, it's based in the United States, and while coffee consumption is strong there, the growth in coffee consumption is modest, simply based on the fact that disposable incomes aren't changing very much, and the population growth is relatively modest. But then we also have growth change into consumers and producers. If you break the coffee market down, it's 150 million bags of coffee are consumed every year. 100 million bags are consumed in consumers, the United States, the European Union, Japan, sort of mature coffee markets. And 50 million bags are consumed at producer level. I should put this down. And that means that the growth there is strong, and it has been in the last couple of years, but that growth is based in Robusta. So I don't want to necessarily say that I think that that is going to change, because these producers, as emerging markets grow, as domestic demand increases due to increasing disposable incomes, what we find is that they generally go for Robusta. That doesn't mean necessarily they won't change to Arabica at some point, but Robusta is the most important part there. And what this means is that since the demand has been shifting, the actual production has been shifting. And what we find is that Robusta production, since it's been going up quite heavily, thanks of course to Vietnam and the output there, and while Arabica production has been going up at a more modest rate, we find that the share of Arabica in global coffee production has actually been falling now for about 15 seasons. Now, I think that, I'm going to go back here because I want to also mention that while we believe that demands in the new season for Robusta and Arabica are going to change a little bit, this is another thing based on the ARB, it's also a function of low prices of Arabica, and it's also a function of a Robusta market that is much more supported by lower certified and consumer stocks, a Robusta market that is supported by farmer holding coffee off of the market, and a Robusta market supported by a lower surplus. All of that means that I think we're going to see Robusta demand still be around average, but we think we're going to see Arabica demand pick up a little bit. Now, if we look at production as just a function of Brazilian production and non-Brazilian production, we find that the Brazilians, as we learned just a couple of moments ago, have quite a lot of scale, and the efficiencies that have been built into that scale have allowed them to take over more and more of the Arabica market globally. This is important because this increase in Brazilian Arabica production is not generally a function of increased area. It is a function of efficiency and yields, and generally that's a function of inputs. If we look at the three big majors, the Vietnamese, Brazilian, and Colombian production, we do find that Colombia and Vietnam have been producing, increasing production quite significantly. And again, Serge mentioned this. This has been a production increase based not necessarily on land increase, but it's been a production growth based on input use, the function of fertilizer, as well as other dynamics. What that means is that when prices drop below the cost of production, those inputs are no longer used, or they're not used at the same scale to produce the same kind of yield growth. And this is important now because in Arabica, at least, we have cost of production above the price in New York and above most of the differentials as well, which means that instead of farmers focusing on production and increasing output by use of fertilizers and inputs, fungicides, pesticides, I didn't even touch it. We find that they're going to stop that, and that actually is going to be impacting output in the coming years. You know, and I think one of the things that really surprised us and that has been really relatively bearish the New York market is also the coming back into the market of Colombia, who has now have had quite a successful renovation program and are selling. So it's an interesting dynamic if you put the price of Colombian milds reported as from the ICO and the actual exports of Colombian coffee. While the price was extremely high, of course, their export levels were relatively diminished, but now have come up quite significantly as the price goes down. Of course, there is a subsidy currently in Colombia impacting the amount of coffee that is coming out, I believe, but this generally just means that people are not able to hold this coffee off the market in the short term. And so if we distill all of that down, we find that for Arabica, well, we have a 12-13, a very large surplus of 12-13 that the market is still trying to absorb and work its way through. The 13-14 surplus for Arabica is lower. And this is also impacted by the fact that the Brazilian government is currently implementing a program to remove 3 million bags off of the market, which ostensibly is actually almost that entire surplus. But I don't think the problem is necessarily the 13-14 surplus. I think many people in the market, like, again, are looking to the next season and looking at the 14-15 surplus, which is difficult to see. It's like trying to forecast weather. If you go further out, your variables increase exponentially. But if you look at 14-15 and model it based on previous growth in production and demand, we find that there's still going to be an Arabica surplus of 5 million, somebody's telling me to hurry up, 5 million bags. The certified stocks, I mentioned this earlier, the London certified stocks at a multi-year low. This is certainly going to support that market. The certified stocks for New York, broken down by level, they're not necessarily as high as they have been just 5 years ago. But I think industry isn't necessarily worried about these levels at the moment simply because they understand that there is coffee available. And there's coffee available on the spot market, so this isn't necessarily a concerning factor. But it does still impact this arbitrage that I've been talking about between these two markets, extra supply. So there is going to be quite a lot of output coming on. So in general, the fundamentals suggest that at least in the next 18 months, the supply of coffee is going to be more than ample, and this is going to continue to put pressure on New York prices. But the New York prices are again going to have to transition with Robusta prices, and their arbitrage there is going to be in play quite a bit in the next year. Another important aspect, of course, is currency. And I'm not a currency FX analyst, but I do want to talk about this. This is very simply a number of coffee currencies normalized back to 100 for January 2011. And you can see that India and Brazil, their currencies have devalued quite significantly. What that does is that is supporting exports, generally impacting the cost of production, and is relatively bearish for coffee. A number of other entities, of course, you have down here Colombia. Down here, Colombia and flat, you have the Costa Rican currency, are not being supportive for coffee producers and the coffee market there. An example of that is this. For the New York market, if you normalize the prices going back to March 2011, and you put one price in Brazilian real and one price in US dollars, you find that the Brazilian real price hasn't fallen as much. In fact, about 15% less than the New York price in US dollars. And so if you go back to a more historical point, and this is something to look at for the outlook in the coming years, this is the Brazilian US dollar real relationship, and this is the price of coffee in New York, Arabica. And we find that when the real was very devalued in the beginning of last decade, I was at the same point of the coffee crisis. Brazilian producers were still many times able to actually cover their cost of production based on this exchange rate. So now is a big question of what the exchange rates are going to do. This is the BNP Paribas FX analyst forecast for the new year for the Brazilian and US dollar cross, as well as the Mexican, the Colombian, and a couple of others. And they believe that at Q3 2014, the relationship should be 2.75. That is relatively bearish, the Brazilian currency, of course. And if you were to model that and just look at historical perspective, that would suggest coffee prices below 80 cents. But there are a couple of things I think one must take into account. And one of them is that the Brazilian government has already devoted quite a lot of resources in supporting the currency this year. When the summer came about and the Brazilian real devalued quite a bit, the Brazilian central bank came in with quite a lot of money to support that. And I think next year is an election year, which is going to support that again, because nobody's going to want major fluctuations of the currency in an election year. Also, people tell me that there is a small football tournament going on in Brazil next year, and apparently you don't want to, so I think the government is going to basically put many resources into leveling out the real-US dollar relationship. So, I mean, you can take that, that forecast, which would be a very relatively bearish outlook, but there's other things I think to take into consideration. One of the things to take into consideration, of course, is hedge funds and other funds. Let's look at one of the supportive factors, index funds, who are usually long-only funds who buy based on the relative value of agricultural commodities. This year, in January, they purchased about 12,000 contracts of Arabica in New York. And they helped the price of Arabica go up about 8% in a couple of weeks. And it's likely that they're going to be buying coffee again this year. But the problem is that last year, so 2012, coffee was the worst performing agricultural commodity by far. And a number of other markets were much higher. But this year, in 2013 to date, coffee is not even the worst performing. Corn is. And everything is in the red, which means that index funds are going to have quite a lot of commodities to be buying, which means I believe they're going to be purchasing probably less than half of what they bought in 2013, meaning the support level there in January will be certainly diminished. Of course, it depends on who's selling and the dynamics in the market, but we do think there's going to be a little bit of a bump. Hedge funds, though, these are long-short hedge funds who are basically basing their positions on the fundamental outlook and what they think prices should be based on the supply and demand. They've been relatively short the last year, basically during the entire fall of Arabica in New York. I believe that hedge funds are going to remain shorts in the Arabica market for a number of months, probably through the next year. They believe that this oversupply of coffee is going to require then a much lower price. And they see the industry cover, they see a number of other dynamics and believe that prices probably have downside risk. But if you look at the share of open interest, so basically the percentage of what they are in the market, it's relatively high. It's about as high, it's even higher on an average basis than where it was in the coffee crisis. So that begs the question, how much more contracts, how many more contracts can hedge funds sell into the Arabica market? And I think they can sell some. I don't underestimate their ability, and I certainly don't underestimate the amount of money they have sitting in their pockets wanting to make money. But I believe that there's a couple of factors they're going to take into consideration. One of them is the index fund buying I mentioned a moment ago. And another one is the fact that I think prices in New York are going to be under pressure in Q1 and Q2 of 2014. You may even see prices go below $1. This is something we anticipate. So when prices go below $1, let's say they're at 90 cents in the middle of next year, the risk-reward benefit of being short, having this massive short position right here at 90 cents, especially considering that you're going to have a frost season in Brazil coming on, you're going to have potentially 10 cents downside from 90 cents, but you have probably 40 cents of upside. Means the fact that which means from my perspective that their ability to stay this long is going to be an endemic factor in the coffee market for the next year. But their ability to grow their short position beyond where it is now is going to be limited, which means that while there is a bearish dynamic in the market, how much more selling from hedge funds we're going to have is quite questionable. So generally, our outlook. So you saw this graph before, and now I've added our forecast in red there. You ask the question quite often, how low do you think it can go? And I think it can certainly go below $1. $1 is a very supportive level of coffee prices in New York that we've seen the market bounce off a couple of times in the last 5-6 years. And I do believe that if it were just a function of supply and demand, we potentially wouldn't necessarily go below $1. But the outlook for the Brazilian real suggests a bearish mood that, in our view, will send prices actually below the dollar level. But we don't think we're going to follow in the footsteps of 1997 to 2000 simply because of a number of impacts I mentioned. The amount of selling that the amount of selling that hedge funds can do from this point on, the idea that the Robusta market is actually going to act as a somewhat supportive factor for Arabica. And you have to remember that everybody in this conference and many people within the coffee industry are relatively bearish of the market. But at the same time, when you're bearish the market, many people are holding off from buying and trying to find when the inflection point will occur when prices go back up again, which means that there is a lot of buying waiting on the sidelines. And I don't think that the rally we saw on Friday, for example, I don't think that that's necessarily going to bring in an onslaught of buying. But I think that if we continue to fall in the next 6 months, there will be a point at which people will say, on an upside, this is the point in which I'm very happy in getting in and buying more. So while I don't think that there's going to be a major rally, I'm trying to assume that there won't be any supply disruptions. Of course, there could be a rally if there's a short covering rally, but I don't think it would last very long. It would be very similar to something like this. I think we're going to be relatively flat moving forward, but that we will, and this is important, we will bottom out in 2014. And also, the coffee market, very forward-looking, was probably going to see the 15-16 season and beyond, and see the amount of production that may be lost because of these low prices. And instead of another surplus we have when there's an off-season 15-16 season, maybe we'll go back into deficit, which isn't probably enough to change market sentiment based on ending stocks, but is enough probably to stem the tide and stem this trend we have going lower. These are the actual numbers and some points, and these are the fundamentals which are, you could, I'll be here all day. If you'd like a copy of this report, I'm happy to give it to you and email it to you, so no need to take photographs. And there's the numbers as well. And there's my contacts. I'll give you that as well. And of course, almost the most important part, the bank's disclaimer.